Good morning. It's Jeffrey Christian of CPM Group. It's about 10:15 on the morning of Tuesday, the 11th of April, here in New York City. I wanted to talk today about the relationship between gold prices and some economic indicators such as interest rates, currency exchange rate, the trade weighted dollar, and inflation. I think there continues to be some issues about it. And I'd like to explore that. As we're speaking, gold is around $2,016 and silver is about $25.13 or so. So the prices have risen. And I think there's a lot of confusion about the relationships and interrelationships. And the grounds I'm going to cover today, we've spoken about repeatedly. Not even, just over the last 2 years of these videos, but over the last 40 some odd years of my career. One of the points that we like to make is that sometimes you see the dollar and interest rates and gold prices moving in one direction or another. And people say, well, the dollar or gold is reacting to the dollar, gold is reacting to the interest rates. And sometimes that's true. But more often than not, I think what you'll find is that interest rates and the dollar and gold and the stock market, bond prices and other factors are all reacting to some other independent variable. And I've made this point repeatedly over the last few months because I think it's been very important in the current situation in terms of financial markets, gold prices, silver prices, etc. And yes, I'm talking about gold, but the things I'm saying also apply to silver. So I think what you have to do is you have to say, okay, is gold reacting to interest rate changes or to the dollar's currency exchange rate change? Or is the dollar and gold reacting to the same thing and it's something else? And you'll see that more often than not. And that's definitely been the case here. We've talked a lot about fiscal policies, the stalemated government in Washington, economic and political and social problems in the United States and in other countries, the war, Russia's invasion of Ukraine and that ongoing war, U.S.-Chinese tensions, and changes in the international political, financial, monetary, and social interactions. All of those factors will affect interest rates and the dollar and gold. And you'll see interest rates rising, and it may be because people are worried about inflation and they think the Fed can't control it. And that's good for gold. And you'll see interest rates rising, and people will say, the Fed's getting inflation under control. And that's bad for gold. So again, it really depends a lot on what's going on there, and why it is that interest rates are changing, or the dollar's changing, or the stock market's changing. I'll try to come back to what it all means for gold and silver at the end of this. But let's run through some charts and some data. Again, the blue line is gold prices. The orange line is the nominal Treasury bill rate, and the purple line is the real inflation-adjusted Treasury bill rate. Real interest rates are very important to gold. You can see back in the 70s when real interest rates went negative and stayed negative for most of about 4 or 5 years, and the gold prices rose very sharply. But again, if you go back and you look at what was going on there, inflation was very high, deregulation was very large. You had the Vietnam War at the beginning of that decade. You had OPEC asserting control over oil prices starting in the late 60s and early 1970s. The oil embargo, the overthrow of the Shah of Iran, the taking of U.S. hostages, the Soviet invasion of Afghanistan. You had all sorts of other factors that were affecting interest rates and were affecting gold. So to say that, well, gold prices rose because interest rates, real inflation-adjusted T-bill rates went negative, could be true, But it is a very superficial understanding of the way gold interacts with the world. Then you got to a point where Paul Volcker came in October 1979 as the Fed chairman. He changed the way the Fed operated. He started targeting inflation instead of interest rates. Interest rates rose very sharply. We had real interest rates up until about 2002, 2003. And in that environment, gold sort of moved sideways. We went back negative in terms of T-bill rates in the early '80s, and we've basically been negative ever since. Now you can see, again, that big increase in nominal rates over the last, since March of 2021. And you can see how real interest rates have actually risen even more, but they're still negative. They're negative, about negative 0.3, negative 0.4. But we've seen nominal interest rates rise from 0 to 4.8%. So there's a 4.8% increase in nominal rates. And we've seen inflation come down about 2% over that same period of time. So the inflation-adjusted interest rate has gone up about 6% or 7% during that time. But the rate of change is important. The levels is also important. You're still at 4.8% interest rates, which you can see is very low compared to the interest rates that were in place from 1968 when the gold price was free to float, and 2002. Post 9/11, the beginning of a lot of things that were going on that were bad for the economy. So you have much higher interest rates, but not so high. And you're seeing that reflected in the real economy. Interest rates have slowed inflation, but it hasn't thrown the economy into a recession. And there's several things that are said. I'll show you a chart about inflation later, but there's several things that are said about the economy and inflation than the Fed that just aren't true. But they're said over and over again, and I guess that makes people believe them. One is that the Fed is trying to reduce economic activity in the United States. The Fed is not trying to do that. The Fed is trying to get inflation under control. It's trying to quell inflation. It does that through a number of mechanics, but there is nothing in the Fed playbook that says, hey, let's slow down economic growth. There's an understanding that if you raise interest rates, it will slow economic growth some and reduce inflationary pressures. The Fed's objective is to reduce inflation, not to reduce economic activity. But you'll hear pundits on the internet and other people who know so much say repeatedly that the Fed's trying to slow down the economy. It's not. It's trying to control inflation, and it is slowly but surely doing that with only a nominal or relatively small amount of negative impact for the overall real economy so far. A lot of the slowdown in the real economy is actually not occurring because of rising interest rates, despite what people will tell you. It's being caused by a $2 trillion reduction in fiscal spending stimuli. It's being caused by supply constraints in some sectors of supply, both for goods and for services. And it's being slowing down because of the fact that it has been very strong for 2021, 2022, consumer demand and business investment demand. And with the reduction in fiscal stimuli, reduction in tax breaks for wealthy people and large corporations, and the fact that you've seen a big increase in both consumer and business spending and borrowing, you're seeing some cooling of demand from both businesses for investing in expanding their businesses and from consumers. Relationship between gold and interest rates. This is a scatter plot showing changes in interest rates and changes in real gold prices. And again, that's apples to apples. as opposed to apples to oranges. If you compare interest rate levels to changes in gold prices or changes in nominal gold prices or actual gold price levels, you get different numbers. But that's apples to oranges. You're looking at a level of interest rate, the cost of money, if you will, the cost to borrow money, and the gold price. If you look at changes in real interest rates and changes in gold prices, real gold prices, you get a correlation of about 16%. Again, this goes to the core of what I was saying at the beginning. It's not whether or not interest rates are rising or falling or what their levels are is so important. What's really important is to understand why are interest rates rising and what the consequences of those increases in interest rates will be. If the Fed manages to quell inflation over a long period of time without throwing the country into a recession, that's negative for gold. If the Fed fails, that's positive for gold. And the Fed is not the sole actor in this drama. Fiscal policy, consumer and business behavior, much more important than the Fed's behavior, with all due respect to Milton Friedman. And again, going back to that, look at the real interest rates. When real interest rates have been negative 3-4%, as they are now, it's basically been positive for gold. Our gold prices have been strong in that kind of environment. It's taken real interest rates of plus 3% for you to see a correlation between the levels of interest rates and weak gold prices. So real 3%, and we have 6% inflation. So real 9% interest rates. Let's be nice and say that inflation is going to 5. You need 8% or 9% nominal rates before you should expect gold prices to really be weak. So changes in interest rates at these levels from 0 to 5% are not necessarily negatives for gold in terms of past interrelationships. Gold and the dollar. And all of these charts are from our gold yearbook, which we released 2 weeks ago today, and the 2023 gold yearbook. And they go through the fourth quarter of 2022. The dollar obviously has fallen further in the first quarter of 2023, but it doesn't show up here. But again, and you have to look at this, this is the dollar on an inverted scale. So as that green line goes down, the dollar is rising. And you can see through the fourth quarter of last year, the dollar actually was rising. Now it has fallen. It hasn't fallen back to levels that we saw in the middle of last year, much less to the levels that we saw from 2006 to 2016. But the dollar has been coming off. Gold actually was coming off in conjunction with the dollar. So they were both declining, they were both rising, the dollar and gold, over parts of 2022. Again, the relationship is not all that dynamic. And then everyone's favorite, inflation. And again, you can see gold prices going from $270 an ounce in 2000 to $2,000 an ounce in recent years, in a period of time when inflation was 2%, 3%, and declining. Inflation has got up almost to 9% the middle of last year. It has been declining ever since that time. Gold prices have stayed higher. Put it all together, and again, this table is in our gold yearbook. The top line is from 1970 to 2022. And you can see the relationship between gold and inflation, 8%. Gold doesn't move lockstep with inflation. The trade-weighted dollar, negative 34%. 2/3 of the time, the dollar and gold are not moving in opposite directions. If you think that a rising dollar is negative for gold, you'll be wrong 2/3 of the time. Dow Jones and S&P about negative 4% over time. T-bills 1%, T-bonds 3%, negative 2%, and a very high correlation with silver. And if you look at the bottom line, that is the most recent period. And you see, yes, the trade-weighted dollar, negative 40% correlation. So it's become more important. Why? Because people are trading gold off of the dollar more than they used to. Why? Because education in America has gone down the tubes. The relationship between T-bonds and gold has also become more important. And the relationship between gold and inflation over the last 14 years actually has turned negative because gold prices rose sharply during that period of time while inflation was falling until 2021. So putting it all together, you have a complex interrelationship between economic factors, financial markets, and gold and silver. Another big key point that people get wrong, they talk about inflation as a thing. Inflation is a measure of a combination of the effects of activities in the economy. So it's not a matter of quelling inflation. It's a matter of saying, why are these prices rising? Yeah. And I think that inflation, maybe people see it as a beast in the woods outside of town. I don't know. But I think there's a bad conception of what inflation really is. What's that all mean for gold today? Well, we have inflation slowly moderating. We have the trade-weighted dollar still high. It's come off. It looks like it probably might come off a little bit more. But you have to understand that, for the dollar to come off, people have to be much more bullish on Europe and Japan, the other major economies that have liquid, internationally traded markets, for them to say, I'd rather have my money in euros or yen or pound sterling or Swiss franc instead of the dollar. So the dollar has a lot of strength going for it still. People talk about de-dollarization, but they don't know what they're talking about. They're getting it wrong. Most of the trade, something like more than 90% of global trade is still settled in dollars. 60% of central bank foreign exchange reserves are in dollars, and 70 to 80% of private sector wealth is in dollars. And central banks are not dumping their dollars. They're not moving to some phantasmagorical basket of currencies. Brazil, India, China, South Africa, and not saying, let's link our currencies to the ruble because the ruble has been such a great place. It's funny because if you look at monetary reserves of currencies held by central banks, no one holds rubles as monetary reserves. So you're going to see the dollar trading pretty much sideways to slightly lower. You'll see inflation waning slowly but surely. You may well see a recession. That's going to hit the stock markets. Interest rates will probably rise a little bit more. I think that if I had to bet, and there's the two-horse race, one is the Fed and one is the financial markets, I would bet on the Fed. I would bet on the Fed reading the economy right. And then you have to say to yourself, okay, wait a second, what is this beast, the financial markets? There are consensus forecasts that are legitimate. We look at the FedWatch that the CME does, and that's a good consensus forecast. Various news agencies and others collect consensus forecasts from sober, unbiased sources, and they come up with consensus forecasts. The market shows you a consensus forecast every day. Then you have people who sit there and they say, oh no, the dollar's going to collapse, the treasury's going to collapse, interest rates are going to 1,000%, inflation's going to 50,000%. That's not the financial market consensus. And you have to learn to not listen to those people. Yeah. So I think that we do expect interest rates to rise a little bit more late May. and then probably plateau. Interest rates are going to have a lot to the Fed will obviously have a lot to say about the interest rates, but so too will the overall real economy and fiscal policy. And you have to look at those things. You put all this together and you have this litany of issues that the world's facing, and it's a good time to say to yourself, how much of my wealth have I protected from the vagaries of currencies and stocks and bonds and governments by putting it into gold and silver? And do I have enough of my wealth in gold and silver? And what percentage of my wealth should I have in gold and silver? And what percentage of it should I have in other assets, based on the view that while we do see recessions from time to time, they usually end and they lead to longer periods of economic growth than periods of recessionary contraction. And we are seeing inflationary problems rear their heads, but there continue to be disinflationary and deflationary pressures, which were existent before 2020 and probably are going to emerge. They're not necessarily negative for gold. In fact, they could be very positive for gold, as we saw back in the 19th century and the first half of the 20th century. So we put it all together and we say, we've got a lot of issues. Gold doesn't move lockstep against the dollar. It doesn't move lockstep with inflation. It doesn't move lockstep against interest rates. The relationships are much more complex than when a lot of people would like to believe. Everybody sort of wants an easy metric. But the reality is, to get your investments right, you have to ignore those easy metrics and really roll up your sleeves and dig into what's going on and why are interest rates rising, or why is the dollar falling, and what's happening with inflation. That's all I have for now. Take care. Take care of yourself and those around you and everybody else, and we'll talk to you on Friday.